Time for Chart Attack, where we bring you a couple of charts that will make you smarter. We hope they will also make you a little bit of money. And Josh, hey, we're talking about risk assets and comparing the picture at the big banks versus the picture at the small banks.
Right.
Let's start with the big banks and walk us through this.
Well, so the big banks, there's been concern about interest rates rising. What does it mean for the interest rate risk of the banks and how well they're hedged or how well their exposures are going to work out for them? The reality is the big banks have moved most of their exposures, their interest rate exposures, it seems, to the Fed, with the sale of all the mortgage backs to the Fed.
Sure.
And so they're actually fine on the interest rate side. They've got problems, as we see, based on trading and based on the impact of the end of the refi boom, which fell off really quickly, really dramatically. But in terms of as rates rise, the big banks seem like they're in okay shape.
And as we said here, you look at the big banks and they have balanced balance sheets.
Exactly.
The assets match the liabilities.
Right.
That sounds like a good thing, right?
Yeah, no, I think that's right. That's right.
The difference is at the small banks where it's a very different picture.
That's right.
And maybe you can help us understand what's going on.
Right. So if you look at the gap, the assets they've been growing. There's not much they can do with their deposits. It seems, been putting more and more into some of these longer dated assets. The question becomes, what happens when interest rates rise? Are they going to end up seeing it continue? Or are they going to end up having problems with the interest rate risk? The problem is that the big banks can hedge, the smaller banks really can't hedge the exposure.
And explain what's going on here on this chart. With the big banks, they were paired. On this chart, we see assets at the smaller banks rising, which means it would suggest assets, right? They're making more loans. Isn't that a good thing?
Well, depends on what happens when rates rise. Are they able to continue to put more loans on? And what happens to the deposits and the liabilities. And so really the big question that we have to think about, right now it looks like the banks have a lot of deposits and we think of those as stable. But when rates start rising, typically non-interest bearing accounts end up becoming interest bearing. They've got to pay to hold those deposits. Okay? And so that becomes...
And those liabilities, all of a sudden that lower line gets pushed up, and it might even cross over.
Exactly. And so that's where you've got to think about the concerns. And so who's going to end up with those deposits in that environment? Are we going to see them flow out of bank deposit accounts? Are we going to see them flow elsewhere for yield? Or are we going to see the banks have to pay to hold on to that funding?
Okay, million-dollar question. You have 10 seconds to answer. Should we be worried about this possibility in the next 2 years?
In the next 2 years, yes. In the next probably 6 months, no. I think we've seen most of what we're going to see.
All right, understood. Glad you're here, Josh. It's complicated stuff, but actually you make it a lot simpler.